So before we get started today on the Real Estate Minute Show, I wanted to say a very special happy birthday to my mama. My mom turns, I'm not going to say, on July 21st, and unfortunately, because I'm in North Carolina, I can't be there, and we usually have the family barbecue at my parents' house, and it's a lot of fun, and I'm going to miss it. I'm sure I'll FaceTime, but my mother is my biggest fan on the show. She texts me if it doesn't show up in her news feed, wherever it is, on Thursday mornings when it's released, when I have to, cancel it for a week or so. And she has coffee and looks forward to kind of setting it up on her kitchen table and stuff. So I wanted to say you're probably watching this now, and I'm having coffee with you, and I'm sorry you can't be there, and I love you very much. And let's have some coffee and talk about property insurance. Anyway, welcome back to the Real Estate Minute Show. Everybody's freaking out about property insurance now. A lot of people are. If you've gotten a letter of cancellation, let's say, you've obviously, if you own a home, your rates have probably increased, and you have already talked to your insurance carrier to find out what the hell's going on. You also may have heard that State Farm and Allstate pulled out of California entirely. They are not canceling existing policies yet. We'll see what happens, but it's a big blow because State Farm is number one premium writer in California, and Allstate's number 4, and they comprise, I believe it's over 15% of all premiums paid in the state. So it's a pretty big blow. There are reasons for it. We're going to go over those 4 reasons right now. One is that there is something called reinsurance. Now, insurance is just about shifting risk, So it's like you own a home and you bought it for $1 million, and it's going to cost $600,000 to replace it. And you don't have the $600,000 to replace it, and it burns down. You'd rather Allstate pay the $600,000, and so you're essentially just shifting risk for like a couple grand a year in premium. Now more, because it's been increasing. And that person's going to do it for a small amount of money because they know it's likely never going to burn down. And that's how they make their money. Now, the insurance company has a lot of risk, right? And they do that to thousands of homes. You can imagine it's billions of dollars at risk if there's a fire that blows through the entire state, let's say. Now, that never happens either. And they know that, and they analyze it, okay? But let's say, God forbid, they have too much liability on their books. So what something like Allstate or State Farm does, for instance, is they shift some of that risk also, like we did. They shifted off to another insurance company called a reinsurance company. And a lot of times these are countrywide companies, not by name, but meaning, United States wide or across the globe. These are major reinsurance companies, and they allow State Farm to continue writing and shifting risk and giving us the premiums that we can afford, okay? That market has changed pretty dramatically because of a lot of fires and things, and also worldwide stuff going on. The premiums on those reinsurance risk that they farm off is going up and up and up. Now, they can't just pass those premiums off onto us because once we have an agreed policy, and 2, they can't really increase by a certain amount every year because the insurance commissioner in California only allows and regulates the amount of increase, okay? So they have to pull back and essentially not be able to reinsure some of that risk, and then they have too much risk, and then they say, you know what, too much in California, stop writing new policies. And that's kind of what's going on with State Farm and Allstate. There's 3 other reasons why. One is the fire risk in California is massive. The State Farm, Allstate, a lot of insurance companies have written to the governor for many, many years about fire risk and forest management. Now, the management of the forests is up for debate. It's a climate change debate, or it's lack of forest management debate, thinning, controlled burns, all that kind of stuff, because of the environmentalists don't want that. And they think climate change is this. So there's all kinds of discussion to what it is, and it gets rather political. But that's an issue for insurance companies. It's the kind of construction of these homes that are being required. Do they require sprinklers now? In California, new construction really requires sprinklers in most cases. And so there's a lot of issues like that are going on that increase the fire risk, and that just increase the risk for the insurance companies, coupled with not being able to offload it to a reinsurance company. The third one is construction costs. They're off the charts in California. North Carolina was quoted to build a new home, semi-custom, about $200 to $225 a square foot. That includes the site work. In California, it's twice that. It's $400 to $450 a square foot. So you can see, obviously, much higher risk. And fourth, California has this weird little nuanced rules. And a lot of times these decisions of companies they make is kind of a conglomeration of nuanced issues. Called the efficient proximate cause rule in California. And what that word means, those words mean, I should say, is that If the company, like State Farm, for instance, my house burns down, they come in and they have to pay to rebuild my house. And the cost of constructions are massively high. But in addition to that, they're required in California to cover some or most of post-fire flooding and mudslides. So God forbid there's a big, huge torrential rain after it burns down 2 months later, and it slides off and takes out a house down the road. They could likely be liable for that. So there's a lot of these unknown expenses that could possibly pop up in a covered loss. So those are really the 4 reasons on why they're pulling out. Now, to end this, is people shouldn't necessarily panic. They should have educated panic. They should talk to their insurance provider and find out if they're leaving the market, what's going on, where you see premiums, etc., and watch it more than just paying the premium when you get it every 6 months. It's now an important component. It's like a water bill now in California. It's very, very important as far as home ownership. Florida, Texas, Louisiana, the Gulf states, all have had these issues before, where companies say too much hurricane risk, pulled out, and then they came back some years later. It's all about shifting risk around the country and who's doing what. If there is a, God forbid, big earthquake on the West Coast, I can almost guarantee you that a lot of those earthquake-covered insurance companies will likely pull out of that market for the time being because they just can't afford it. It's just, that's what happens. So anyway, that's the fun art of insurance, something to watch out for. And I hope you have a great week and say no to earthquakes. We're going to be off, which is why I'm wishing my mother a happy birthday. Happy birthday again, Ma. Is because I'm not going to have a show next week, which is, I think it's like the day before her birthday. So I wanted to wish her a happy birthday here for everybody to hear. All right. Wish my mom a happy birthday and take care. Love you, Mom.